It's time to discover the pathway to wealth with our video titled Unlock Wealth, Beginner's Blueprint to Earning Millions in Stocks. The Lux Life. In today's episode, we're diving into the world of earning millions through stock investments. We'll cover essential topics like long-term investing strategy, financial preparedness, diversification strategies, and more. Stick around until the end to learn how you can be the first millionaire in your family through stocks. And hey, don't forget to show some love to Lux Life. Alright, let's begin. Long-term investing strategy. When it comes to long-term investing, think of it like planting seeds in a garden. You don't expect a harvest overnight, right? Similarly, with a long-term investment mindset, you're in it for the long haul. You're not looking for quick wins, but rather patiently nurturing your investments over time. This approach brings stability and consistency to your financial journey. By embracing a long-term investment strategy, you're setting yourself up for success in the future. You're not swayed by short-term market fluctuations or the latest investment bets. Instead, you focus on the bigger picture and the potential for wealth accumulation over time. It's like building a sturdy house on a solid foundation. It may take time, but it ensures lasting stability. Financial preparedness. Picture financial preparedness just like gearing up before a big adventure. You wouldn't head into the wild without the right supplies, right? Establishing an emergency fund is comparable to having a financial safety net. It's there to catch you if things take a turn for the unexpected, especially during market downturns. Think of your emergency fund as your financial cushion. It's money set aside specifically for emergencies, like unexpected medical expenses or sudden job loss. Having this fund in place provides peace of mind and financial security, even when the stock markets get shaky. It's all about being proactive and preparing for the unexpected rather than scrambling to find solutions when trouble strikes. So before you start investing, prioritize building your emergency fund. Strive to save enough savings to pay for living expenses for a minimum of 3-6 months. This way, you'll have a solid financial foundation to rely on during challenging times, allowing you to weather any storm that comes your way with confidence and stability. Tax-advantaged accounts. Now, let's talk about tax-advantaged accounts like IRAs or 401k. They're like special savings accounts that give your investments an extra boost. How? Well, these accounts come with tax benefits that can help you maximize your investments' returns. Think of it as getting a little extra help from the government to grow your money faster. So here it works. When you contribute money to tax-advantaged accounts like IRAs or 401k, you're often eligible for tax deductions. That means you can lower your taxable income for the year, which could potentially save your money on your taxes. Plus, the money you invest in these accounts grows tax-deferred, meaning you don't have to pay taxes on any gains until you withdraw the money in retirement. It's like giving your investments a head start and growing without having to worry about taxes eating into your returns along the way. The beauty of tax-advantaged accounts is that they're designed to help you build wealth more efficiently. By taking advantage of these accounts, you're not only saving money on taxes, but also giving your investments the opportunity to compound and grow over time. Diversification strategies. You will never see a millionaire or even a billionaire with only one source of income. Hence, distributing your bets across several horses in a race is analogous to diversifying your investing portfolio. Reducing the likelihood of flashing all your eggs in one basket is the main goal. When you diversify, you're not relying on the success of just one investment. You have a mix of assets that can help balance out any losses and potentially enhance your long-term growth potential. Imagine you have a garden with various types of plants. Some may thrive in certain conditions, while others struggle, right? Well, it's the same with investments. By diversifying, you're not putting all your money into one type of asset that could tank if the market takes a hit. Rather, you distribute your money among several asset types like as bonds, real estate and stocks. This way, if one sector underperforms, you have other investments that may still hold strong, helping to cushion the blow and keep your overall portfolio growing steadily. Index fund investing. Before we dive into index fund investing, we want to mention that we've got another video about it called Unlock Wealth, Smart Investing in Index Funds versus ETFs for Beginners. If you're curious, you can search for that video here and give it a watch, too. Now, let's get back to it. Index funds is like hopping on a train that takes you on the same route as the entire market. Sounds simple, right? Well, that's because it is. Index funds are like a basket of stocks or bonds that track a specific market index. Like the S&P 500, instead of trying to pick individual winners, you're investing in the overall performance of the market. It's a straightforward and low-cost way to mirror the ups and downs of the market without all the guesswork. So how does it work? Picture this. You buy shares of an index fund, and those shares represent a tiny piece of every company in the index. As the market moves, so does the value of your index fund shares. It's like being part of a team. When the market wins, you win too. Plus, because index funds simply follow the market, they typically come with lower fees compared to actively managed funds. That means more of your money stays in your pocket, helping to maximize your returns over time. Automation of investments. Another topic that we will be discussing is automation of investments. This is like setting up a robot to do the heavy lifting for you when it comes to growing your money. Instead of manually putting money into your investments each month, automation lets you schedule regular contributions. It's like putting your finances on autopilot, ensuring that you stay consistent and disciplined in building your wealth over time. So why is automation such a game changer? Well, think about it like this. Life can get busy, right? Between work, family, and everything else going on, it's easy to forget to invest regularly. But with automation, you don't have to worry about remembering to make those contributions. It's all taken care of for you. Plus, by investing consistently over time, you're harnessing the power of compound interest to supercharge your wealth-building efforts. Fundamental versus technical analysis. Now, let's compare fundamental versus technical analysis, two different approaches to evaluating stocks. First off, we have fundamental analysis. This method looks at the underlying factors that could affect a company's value, like its financial health, earnings, and growth potential. It's like digging deep into the company's DNA to understand its true worth. On the other hand, we have technical analysis. This approach focuses on analyzing past market data, like price movements and trading volume, to predict future stocks' price movements. It's like studying the patterns and trends in the stock market to try and anticipate where it's headed next. While both fundamental and technical analysis aim to help investors make informed decisions, they have some key differences in how they go about it. The focus of fundamental analysis is primarily on a company's inherent value, examining elements such as its competitive edge and business model. Meanwhile, technical analysis is all about the charts and graphs, using historical price data to identify patterns and trends that could signal potential buying or selling opportunities. So which method is better? Well, it really depends on your investment goals and personal preferences. Fundamental analysis may be more suitable for long-term investors who are focused on the underlying value of a company, while technical analysis may appeal more to short-term creators who are looking to capitalize on short-term price movements. Ultimately, the key is to understand the strengths and limitations of each approach and use them in combination to make well-rounded investment decisions. Navigating market volatility. Last but not the least is navigating market volatility. It's like riding the waves of uncertainty in the stock market. When things get shaky, it's easy to panic and make rash decisions. But here's the thing. Short-term fluctuations are just part of the game. It's important to stick to your long-term investing ideas rather than letting fear control your behavior. So how can an expert handle market volatility? First off, keep your eye on the big picture. Thanks for watching and don't forget to subscribe.